Well, g'day there, everybody. I just wanted to take the time to share with you another piece of analysis which is relatively interesting. It is also straightforward, very easy to understand. It is just an observation that I'm making in terms of what this market is doing at the moment and what it has done in the past, just to see some of these extreme sort of overbought, overextended readings that we're currently registering across the board collectively, not only just relevant to that of the S&P 500, which is on my screen at the moment, as you can see in the top left-hand corner, but also to a lesser extent, but also certainly heating up, so to speak, and really something that you should be mindful of at this particular juncture. Now, what I'll also do, I'll quickly show you these readings that I'm seeing on the S&P, the Dow, and the NASDAQ, but then I'll also jump into a couple of other additional stocks, really, and potential sort of trade setups. I won't go through a lot of individual stocks, but I do just want to sort of set the narrative of what this market is set to do, just so you can potentially get an understanding of what you should not be doing, in my own personal opinion. Now, you can do whatever it is you choose to do. I am well aware of that. But when I personally see these signals on markets, and if I am sort of given the opportunity to start legging into, say, for instance, bullish breakout trades in individual stocks, and I'm going to reference one for you. When it comes down to this, rather, I would, at this particular point of my own trading career, is just simply not take the risk. And the reason for not taking the risk is because generally when markets register these current levels, we start moving into a sideways, choppy, whipsaw type of trading nature or trading environment. And there's a big difference between that of a market that has been trending, so to speak, on the S&P 500 for about 2 months now, a little over 2 months. It has been a very profitable time for us. We've had a lot of open orders, say for instance on the SPYs or even on the diamonds as well. And we've just been taking advantage of this trend as it has progressed. But there always comes a point where the trend itself begins to slow and then it moves into a sideways consolidation. And what that means essentially is that we get into a trading period or an environment that isn't as conducive to trending trades. And we've, again, taken complete advantage of this trending market. It's been a tremendously profitable period for a lot of people. But at the same time, that sense of reality is going to surface again. And simply what that means is that you should be sort of harvesting your profits at the moment. And you should be thinking about, well, when is it that I'm going to start looking to sort of jump into new trades? And at the moment, again, the narrative for this, the message that I want to share with you is that, look, sometimes in the world of financial markets and trading, it's best to do nothing, or it's conducive at least to do less. Less is essentially more. So what I'll do for you now is I'll share with you that of the S&P and just go through this ADX reading that we're currently registering. First of all, I want you to pay attention to this reading just here on my screen. This is the ADX. It's registering just shy of 70. It's registering at 68.29. Now, in and of itself, this number is largely redundant. It doesn't help us all that much. On its own, it's not really telling us all that much, except that the trend itself is strong, it's healthy, and it is legitimate. What makes this signal very important and very useful and tremendously valuable for us as technicians is that we can go back historically and ask ourselves the questions, well, how far does the S&P generally move in terms of momentum and the trend before it essentially stops, it slows, and it moves sideways for a number of months, if not 1 month, before we see the ADX reset back down at the signal line, which is coming in at 20, this dotted line on my screen, which gives us the signal in combination with our rising exponential moving averages, which is supporting the trend for the trend to begin trending again, if that makes sense. A little bit of a tongue twister, so to speak, but again, relatively straightforward. And the reason for this is because if you pay attention to the ADX, which is registering just shy of 70, you have to go back and say to yourself, well, is this high? Historically, is this high? And this is taking in price action dated all the way back to August 2016 on my screen. And here I am before you saying, yes, this is historically high. It is so high, in fact, that when the markets, all right, when President Trump-elect happened back in November 2016, the market went berserk. It just rose. It was like a spaceship headed for the moon, so to speak, and it lasted like that for about 1.5 months through to about mid-December before it slowed and moved sideways. Well, if you look at that ADX reading, it peaked out at 64. And again, here we are at 68. We slowed for 2 months, and then we let the ADX reset. It turned up. It liked the bullish momentum. It liked the bullish breakout. It liked the bullish trend. But again, we plateaued at about 64, and this was taking us into the month at the beginning of March 2017. What happened? We slowed for 2 months, we moved sideways, we let the ADX reset, and then it's been sort of more of a gradual climb. We have moved into more sort of sideways consolidation periods until the most recent breakout, where again, as we transition into Wednesday's trading session, we're seeing this ADX all the way up at 68.29. This is a really big reading. It's not to suggest that the trend itself has to reverse, but it is letting us know that we're towards the end of this most recent sort of mania, this buying mania, which has been flooding the markets. And it's something you should take note of. It's very important because, again, the market will naturally, the ebbs and flows of it, it will have to adjust, it will have to reset, it will have to slow down. And even if you pay attention, for instance, on the Dow Jones Industrial Average, just at the elevation or the slope of this most recent bullish attack, I mean, you have to ask yourself, is this sustainable? And I would come to the conclusion, very humbly, that no, it's not. Yes, it makes us very happy when we see, of course, those profits build in those trending positions. But at the same time, you have to have that sensible, rational, responsible discussion with yourself and ask yourself, well, when do I want to start liquidating these positions? And when do I, of course, want to sort of disconnect myself from, essentially or fundamentally the greed element that naturally flows into and hinders potentially at times your decision-making process, all right? It's very, very important that you understand this and you're cognizant of it, because right now it's very dangerous essentially to be jumping into a ton of bullish trades. As you can see, the ADX isn't as skewed historically, or it isn't as high historically as to what we have been in the past. We are still registering at 68.28, but if you go back again to the period of November and December, we got as high as 85. Now, this was largely an anomaly. It really was. I mean, I don't think we've really registered as high as what we have over here for a very long time. This is going back more or less to 2011. If you pay attention to this peak in the ADX reading, if you look to the left, of course, this is going back in time. You can see that we haven't seen a peak in the ADX as high as this one reading over here. Now, if I bring up the horizontal drawing line tool as well, you can see if I pretty much put the ADX where we currently are registering, you have to ask yourself, how many times have we hit it and what has happened next? We've hit it once, we slowed. I mean, it's not the best chart because I'm using so much data. But if you pay attention to this, and if you just go back, you've got one instance here. This was in February. We have a second instance all the way back in November 2013. 3, 4, and 5. So 5 times since 2011, mid-2011, have we hit current overbought readings. And naturally, if you go back and look at what happened next, we more or less slowed. And again, the reason for this is just to show you that this market is overheating. It is overheating. Also, on top of that, my NASDAQ target, 6,648, is almost hit. We've got 6,623 as at the close on Tuesday. So we're getting very close to some of these Fibonacci expansion levels when it comes down to confluence, measuring past waves of momentum and then extrapolating them out to find multiple areas of potential resistance with those Fibonacci expansion levels. And that is very, very precise, especially on the NASDAQ. It is my favorite, so to speak, of that piece of analysis when I start practicing it or applying it to the real world markets that we look at, especially the Dow, the S&P, and the NASDAQ. The NASDAQ is my preferred choice of the three markets when it comes to that piece of analysis. Now, getting back into the original discussion, now that we know that essentially the markets are, relatively overbought, I think we can all agree on that. It comes down to the point where, look, say for instance on Facebook, where you sort of offered a pretty decent trade. I mean, if I just quickly draw a resistance area in here, you can say to yourself, well, Facebook seems to be on the precipice of breaking out. If I change to, of course, the CCI and the ADX, they also support this move. You can see that ADX has turned up. The CCI is just broken above positive 100. These are all analysis tools that we can apply to these types of breakouts. Of course, we're going to be trending above the exponential moving averages. I can go through the entire process for you, but really it is this, if I can just bring it down or sort of deduce it down into a relatively straightforward piece of analysis, you come down to the question, I guess you ask yourself, well, do I want to jump into Facebook, for instance, on the potential of a breakout with the markets being as extended as they are? And for me at this particular point, again, in my own trading career, I would rather sit or side on the side of caution. I'd rather be more cautious instead of risking a lot of the profits that we've made over the past number of months to try and execute a breakout, so to speak, on Facebook. I'd rather let the markets sit. I'd rather let the markets digest naturally what they've already sort of built into the markets in terms of the appreciation of points across the board collectively for those big market US indices or the big US market indices. And there should be another potential once those markets reset that Facebook may be relatively unchanged in a couple of weeks' time. Now, on top of that, we also have an earnings announcement for Facebook, which is scheduled for the beginning of November. So not only are we potentially jumping into a breakout of an individual stock which is coming at a relatively overbought, overextended market, we also have a finite future date which really isn't all that far away. I mean, this is scheduled the 1st of November. And I mean, if you just count the number of trading sessions, there couldn't be more than 10 trading sessions between potentially legging into this if it was to actually trigger on Wednesday, and when we'd need to actually close out the trade as well. So I can sit here and say in full confidence that, look, I can identify that Facebook is a pretty decent trade setup for a swing trade, but at the same time, I have my reservations as to why I'm not necessarily, or why I'm not personally jumping into this trade. And I've just shared with you why that is, and that is the natural sort of overbought readings on the markets and just some of those resistance areas that we're sort of jumping on up into. And again, this is common for a lot of individual stocks as well. If I continue the analysis, one share that is sort of sticking out to me is this potential LUV trade. A lot of people might look at this chart and say, well, it's relatively bullish. I mean, we've moved from 50 up to 58. Things are looking good. However, I'd say that this is potentially Head and Shoulders reversal pattern. We're coming back up into this resistance peak that we priced in February and also March 2017. Also, if we start breaking down the candlesticks, we've got a shooting star, we have a hangman at resistance, we have a high wave spinning top, we have an engulfing candlestick, we've got a bearish piercing pattern, we've got an inside day candle, another doji, another hangman, another spinning top, and then on Tuesday we have another shooting star candlestick. This is all at the pivot point, which is occurring at the right location essentially for LUV to roll. The problem is, however, surprise, surprise, we are in the midst of earnings season, and earnings is scheduled on this particular stock for Wednesday, the 25th of October. So we cannot really force a trade on LUV either. We simply have to let it sit, let it move through earnings. But if we didn't have earnings, I would be having my bearish trigger more or less below this candlestick here, which is being priced in at about $57. I know it's counter trend to the overall markets, but it does fit the profile of the natural correction or the consolidation which should take place, and again add weight to potential downside pressure on a lot of these individual stocks. Now, the final stock I want to speak about is MU. I've had a lot of people email in and just point this out to me. We went through some detailed analysis on MU during the month of August 2017. Actually, if you go back to the YouTube channel and just go to the month of August, you'll probably see some titles, or at least you'll find some analysis on MU at this particular point. And I was talking about, again, the importance of this green support box. Also, if I go out to the weekly chart, this was that of the rising support line, or otherwise known as the bullish trend line, that we were coming down and retesting. Now, as you can see, since we retested this bullish trend line over here and we retested the green box, this is what we call a hammer at support. I've been following along with MU since. I haven't been speaking about it though publicly. You can just see that naturally we've gone absolutely berserk. We've more or less moved from 27. We're currently registering at 40.39. And again, what has been a tremendously powerful and profitable move looks to be coming to an end, albeit short term. What we're starting to see is a collection of reversal candlesticks up and around this resistance area. It looks as though this the sell side volume is starting to build, and it looks as though this is going to be that temporary top for MU. So along with the markets really pushing up into these really extreme levels, a lot of these individual stocks have been moving with the market naturally, but they are looking to, of course, short-term price in some form of a top. And whether that means MU is going to come down to 36, I'm not quite sure at this particular point. But again, I wouldn't be jumping in and trying to take the breakout trade above the high of the candlesticks which developed on the 10th and also on the 11th of October. So I hope that makes sense. If you've been listening along, again, there are a lot of stocks also that are pricing in positive or favorable divergence as well that I could equally talk about. But really what I've essentially hit on was everything that I wanted to discuss in the second video for today. So if you have any questions, email me again, success@pivotpoint-trading.com. I wish you all a splendid rest of, or the remainder of the week's worth of trading. Email me if you have any questions about what I've just moved through. And I'll be back again with you in due course, all right? So all the best, everyone. It's James signing off on behalf of Pivot Point Trading. Goodbye.